Hello everybody, this is Rob, and in this video what I'm going to do is I'm going to cover what I consider the characteristics that I use when determining when to enter a counter trend trade. My motivation to make this video, and I've made a number of other videos, this is not the first time, but I haven't made one on this topic specifically, and I felt compelled to do this due to the fact that I've witnessed over the last, I don't know, month or so, many traders of varying levels of experience take some pretty significant losses trying to go against this massive trend of dollar strength that we've had in the Forex market, no matter what pair you're trading. I tend to trade only the euro dollar and the pound dollar, but I have made some other trades with the Aussie dollar and actually the yen pairs as well. But what I wanted to do is just go over my rules for people to consider, and it doesn't mean that what I use is etched in stone or it's the best method or anything else, but I just want to share some of the techniques that I consider and characteristics that I consider before entering a counter trend position in the currency markets. Okay, so I guess the topic of today is anatomy of a counter trend trade. So the first question you should ask yourself, and many people do, and I've seen a lot of these questions in some local FX website chat rooms, is when do I consider opening a counter trend trade? And I put 3 bullet points up here. The first one is probably the most important one. You should consider the idea that maybe you shouldn't. You shouldn't go counter trend. There's a lot of people that no matter what, they never take a counter trend trade. In my opinion, this is a very valid way to trade, because you have a much higher probability. Now you're not going to get as many trades, and sometimes you may sit around for a few days and not have a trade at all because you're just looking to continue the trend, which is fine, and it's actually a safer way to trade. But for me, it takes too long. I'm intraday and I'm looking to take 1 or 2, maybe 3 trades a day, sometimes more than that if things are really moving. All right, and when we're in counter trend mode, I have to be ready to go, because to me that's missed opportunity. All right, but if you're not that type of trader, then just take bullet point number 1, stop the video, and go on with your day. All right, consider the idea that maybe you shouldn't be counter trend. Number 2, counter trend should not be your primary style of trading. All right, you should not sit around all day, and I don't think many people do, and wait to go against the trend. All right, that should not be. If it is, I guarantee you it's going to be very difficult to be profitable in the long run. So it should not be your primary style of trading. Number 3, you should consider going counter trend only if price reveals that there is an entry. All right, I personally don't use Fibbo levels. I don't use moving averages. The big one that I see a lot of people use is RSI, relative strength. I don't use that one, and that doesn't mean that they're not valid and they're not something that you should consider. I just don't use those. I tried to eliminate many of the considerations that I feel aren't as strong as others. So that's just my personal opinion. So let's look at what I do consider valid characteristics of determining when to take a counter trend trade. I think if you look at number 1, the first thing you have to determine is whether the trade is in fact a counter trend trade. And you do that by considering what I call your mid-range chart to your longer term chart. You determine the trend on those 2 charts. And let me show you what I mean, because I really think it's important for people to consider 3 levels when they're trading. And what I mean by that, you should have 3 charts open, different time frames, when you're determining to enter a trade. Let me show you an example. That means if you look at my current chart of the euro dollar that I use every single day, okay, I have multiple time frames on the same screen simultaneously. Now, what does this mean? If I look at what I have here, all right, I have 3 euro charts and 1 pound dollar chart. And this pound dollar chart is generally M15. I had it on M5, but I usually have an M15. I consider this a parallel pair, but I like to see what the pound is doing at the same time that I'm considering opening a position with the euro, because these pairs tend, not always, but they tend to trade in tandem. Looking at my setup, and I'm saying this is my setup, it doesn't mean that you have to have your setup like this. I have my entry chart, okay? This is my M3, but it's not a minute 3. This is a medium Renko chart that is self-adjusting with the speed of the market, and it plays right about like an M5 to an M30 depending on the speed of the market. Okay, but it's self-adjusting. This is where I take all of my entries. You can see where I've taken a few entries from last week, okay, And yeah, this is my entry chart. My second chart, my mid-range chart, is this M8, but again, this is a Renko chart. It's not a minute 8 chart. What it is a self-adjusting Renko that adjusts based on the speed of a market, and it is basically an H1 to an H4 depending on the speed of the market. So this is my mid-range chart. And then I have my daily chart here. This is my overall map, okay, and this is just a standard daily candle chart. I have this on the euro dollar, and I have it on the pound dollar for my live trading charts. And they're basically the same type. I color code them so I can easily identify back and forth quickly. If I'm on a smaller computer or a laptop or whatever, I can see it much quicker because I'm not always at home with my desktop and with all my screens. So this is what I mean when you should consider have a way, and this is my way I do it, but have a way to consider multiple time frames simultaneously. Why do you need to do that? Because one time frame's support may be another time frame's resistance. These are all pieces of the puzzle that you need to consider when entering a trade. Okay? And however you do that, that's up to you. Regardless of what your charts look like, you can need to consider multiple time frames simultaneously on one page. When you look at my style of trading, I'm intraday. That means my entry chart is M5 to M30. My mid-range is H1 to H4. My map is daily. Okay, so these are the three main charts that I use to determine when to enter trade. Now, if you're what I consider a midterm trader, then you would adjust things accordingly. Your entry chart should be H1 to H4. Your mid-range should be daily. Then your longer term or your map should be weekly. If you're a long-term trader, then you just move it up one. All right, your entry chart should be daily, your mid-range should be weekly, and your monthly should be your map. Okay, it depends what your style is, how much time you have, etc. All right, but I highlighted here all of these highlighted time frames are what you should consider when determining if the trend is going down. All right, and obviously if we look at the charts, if I go back to the charts again, when you look at my mid-range euro chart, what do you see? Obviously it's a downtrend. What do you see on the daily? Obviously it's a downtrend. It doesn't take a rocket scientist to know that the trend here on both of my longer term charts is definitely a stronger dollar. If you look on my entry chart, you can't determine that, so the entry chart is not used to determine the trend of the pair that you're trading. So let's look at number 2. The price action characteristics that I consider when entering a counter trend trade. Number 1, the first thing I always look at, and I highlighted these two in yellow because they're not deal breakers. In other words, I will still take a counter trend trade even if this does not exist. But first thing we're looking for is indecision candles, and I always look at this indecision candles that appear on my highest level chart, which is my daily chart. Let me show you an example. Now, if you look over here I actually mapped this trade out. I can't remember when the date was. Maybe it was 2 weeks ago, or maybe a week and a half ago or so. And this was on the pound dollar. You can see the pound dollar was losing steam. Now, my first indicator, we had indecision candles. What do I mean by indecision candles? All this is showing that price is slowing down. I don't get into the names or what we want to technically call each candle, or if there's a whole science that people have developed around determining what type of candle is doing what to where. I just like to know if price is continually being rejected at that point. To me, this is called an indecision candle area. The second one, B, is, and in this case, it was not the case because price had not entered on the daily an area of support and resistance. The next area of support and resistance was this box here. We did break an area of support and resistance, so this one failed. All the ones I have in yellow are not deal breakers. These are not ones that if this doesn't exist, that doesn't mean I won't take a counter trend trade. If these are all aligned, then it just gives more power to your counter trend trade. On my mid-range chart, we did have 5 pushes down, and what do I mean by that? After we had a reset, and a reset is 2 higher highs. So I had a higher high here, pull back, and another higher high. On the mid-range chart, we got 1, 2, 3, 4, and you can see that on the 4th and 5th, actually each push is decreasing in strength. It has a shorter length to the push, to the wave. Okay, so the first one was very strong, the second one not as strong, the third one less strength, and the 4th and the 5th were definitely weaker, indicating that price is slowing down again. This is another indicator. Okay, so we did have that one. So we did have indecision candles. we didn't have, this one failed, we didn't have a support and resistance area on the daily. We did have our mid-range chart, 4 to 5 waves of movement. Now here are the ones that I have to see no matter what. On the mid-range chart, all the ones in reds are the ones, if I don't see these appear, this price action characteristics appear, I will not take a counter trend trade. Okay, on the mid-range chart, has price entered a area of support and resistance? Yes, you can see from the gray box here that it has entered. So that one is definitely has to be checked. Number two, a pattern such as a double bottom, head and shoulders, etc. developed in this area. Yes, we have, and you can see I even marked it here. On the fifth wave of failure, we have a double bottom here for price action at a good area of support. So we can check that box. Also, on mid-range chart, evidence of a higher low. So we do have a slightly higher low. It's slight right here. You can see it. A slightly higher low, and then we do have a higher high. So this is another indicator of potential counter trend trade happening in this area. And in fact, it did happen. We had, so check this box, and we did have a good entry trigger, but it was in the middle of the night and I don't think I was around to take it. So I missed that. But if we look and check price, what happened on this trade, this was the pound dollar several days later, or maybe a half a day later, and in fact it did retrace to the area that I had talked about. This was your counter trend trade. But even though that's said, if we look on the real chart, now this is why when I talk about money management, you have to stay, basically money management is really easy. You have to stay with a risk reward of 1 to 1. Why is that? Because counter trend is dangerous. Let me show you what actually happened. Okay, after it went to this level. Looking back, I mean, here's the area in question that I just detailed. Price returned to the area, and what happened? Okay, we had a massive push past the 165 level. Okay, so this is why anytime you take a counter trend, it should be, I mean, if I wanted to take a counter trend on mid-range level, that should have been it at the most. Okay, there's your stop, there's your entry, there's your take profit right underneath where we had we began to see a little bit of resistance in this area, and that would have been the safe trade, because for counter trend you don't care if it does that. Okay, if you catch a trade like that and it takes off, congratulations. But when you have a massive downtrend like that, like you see right here on the screen, the potential of that happening is extremely low, and the potential of this happening, which is actually what happened, is extremely high. So you want to limit your exposure or just bypass it all the way and just not even consider the trade. This price action here is why anytime you get into a counter trend trade, which is number 3, risk management, okay, that means my risk reward ratio for the trade, I am risking, it's just a 1 to 1 gain. That's it. You're not going for any more than that. 2 other pieces of information. If you have a breakout, never take the breakout unless you have a pullback. Here was a breakout trade. Considering number 2G here, it says on mid-range chart, do not take an initial price action breakout. Where is a breakout trade? A breakout trade, if you see, this is another trade that actually I took last week. You can see my entry pattern, and I detailed this because this is a counter trend. Okay, we again, same type of pattern. The one that was missing on this one was we didn't have indecision candles on the daily. Price had actually passed an area of support and resistance, and the waves of movement were irrelevant because we had such a massive push downward. You can maybe read it 1, 2, 3, 4, 5. There's our 5 waves. Okay, but the trend is so strong. It's so strong that it's really difficult to make that out. But you can see that we did have what? Entry pattern. We did have a double bottom here on the mid-range. We did have a nice entry pattern. What do I mean by entry pattern? Well, this is my entry chart. You can see the relativity of it. I have a double bottom here, but I also have a smaller time frame double bottom here. This would have been the initial entry. I missed it. Okay, but then we had a continuation trade that, again, this was a 1 to 1 trade. I'm staying, because I know I'm going counter trend, I'm staying 1 to 1. There's my entry at the break here of this 3-point turn. I'm out right at this level right here, even though we could have taken some more pips. That doesn't matter. This is a conservative play on my counter trend trade. Now let's see exactly what happened after this, because I actually considered adding a position here, but this would have been a breakout of the mid-range chart, which is a dangerous trade. What we would have wanted to do is waited for a pullback in this area and then go long. So don't take that initial pullback, because how many times on a mid-range level when you're going against a massive trend do you see a false breakout? And let's see what happened actually on this, looking at the chart. So looking at this Euro chart, as you can see, here's the area in question where we had the double bottom, and then we did have this initial breakout, but it looks like it worked out okay. Now I can't remember if this is when news was being released on Friday, or what the circumstances surrounding this trade was. Let's look at the entry chart, see if we can get some more clues. You can see where my entry was right here for my long trade, and I took this one for a real tight 1-to-1. Okay, but I didn't take the break. I did not add a position here. See, this is what I'm referring to. You want to be safer with the trade when you're going counter trend as a breakout. This would have been the breakout area. You don't want to take this initial break. You want to wait for a pullback and then a trigger. Okay, but this would have been your entry. All right, you want to wait until this area is tested again, it pulled back, and then this would have been an entry, an excellent entry trigger here. And I probably would have targeted this area just below this support and resistance box. That would have been a great trade. But if I remember correctly, there was no way to get into that trade because it was during the news release. But this is the type of price action you're looking for when I'm talking about a breakout trade. All right, something like this, where you have a double bottom. Here's your first evidence, okay? Double bottom, mid-range. All right, you do have a support and resistance. You do have a support and resistance box. You did break this level. Now you're waiting for the pullback and a retest, which is what we have. And as you can see, it came rejected and then went. That's an excellent entry trigger. But again, I think that this was during a news release. I wouldn't have taken it. But that's the type of price action we're looking for when you have a breakout of a double tap. When you have a breakout of a double tap, and that would have been an excellent risk-reward ratio of 1-to-1 for that counter trend trade. So it actually wasn't a false breakout, even though it was tested. So reviewing the money management, anytime you're going counter trend, you want to stay 1-to-1 unless price really takes off. You need to move your lock profit line. In other words, I have a line that's called our move to break even, or a lock profit line, and that means once price enters an area where if it's not at 1-to-1 yet, but it's an area of congestion from previous support or resistance, that's the area you should put your lock profit in. And again, we want to go 2 peaks back. Let me bring this up on my chart. 2 peaks back on our stop. So for instance, again, if I was going to take a counter trend trade here, which would be an excellent entry, there's 2 peaks back for me. All right, there, probably right in this area right here would have been my lock profit. And my wherever 1-to-1 was is my take profit. That would be in what I consider a decent counter trend trade and managed correctly. All right, because you have to have everything pretty tight on a counter trend, because as many people have seen in the last few weeks, trying to get in front of this freight train here, these candles on the pound dollar, you're putting yourself up for continual losses doing that if you don't manage it correctly, and you don't see evidence of a turn. Here I see evidence of a turn. This is an excellent example right here of a counter trend trade that you would have never taken because you don't have a good entry pattern. All right, I only have 1 peak here. If I would have had 2 peaks, see how I have see I have a double bottom here? This is more evidence. This, you would have said, well, maybe it's going to turn here. It didn't. It sliced right through and kept going. So anybody that tried to go counter trend in this area probably lost. So these are the considerations for money management. How do I know when a counter trend trade has been broken? This is tricky, but basically when price on your highest level chart has experienced at least a 3-point turn, you have to look at the number of higher high, higher lows. Higher high, higher lows. And usually if I see a pattern of 2 to 2, that means price is reset. But number 5 is the biggie, just like when I started this video. If in doubt, just plain stay out. This was a somewhat lengthy video, but as you can see, I have many different characteristics that I consider before I place a counter trend trade. This is the safest way to do it, in my opinion, and that maybe some of my ideas out there might help somebody avoid a loss or maybe make some money. So good luck and happy trading. Thanks for watching.